For 70 years, the 60-40 portfolio ruled Wall Street. 60% stocks, 40% bonds. The simple formula that quietly powered endowments, pensions, and sovereign wealth funds across the globe. But something's changed, and the old model? It's starting to break. The 60-40 structure thrived in a post-war disinflationary boom. As interest rates steadily declined from the 1980s, bonds provided income and safety. Equities delivered growth, and the two assets counterbalanced each other beautifully, zigging when the other zagged. It was elegant, efficient, and institutional-grade boring. But it worked. Until it didn't. Fast forward to today. Global debt to GDP is at historic highs. Central banks are boxed in. Inflation is sticky. Interest rates are rising and staying higher for longer. The result? Bonds are no longer the ballast they once were. In fact, they're dragging down returns. The safe 40% of the portfolio has become the weak link. This is the new macro regime. Fiscal dominance, geopolitical fragmentation, monetary debasement. And that means portfolio construction must evolve, not marginally, but structurally.
Over the past decade, that returned 127%. Not too bad, annualized rate of 8.5%. So replacing just 1% of the bond portfolio, the bond side of this, it boosts your return to 153% and 9.7% annualized. Okay, better. Adding 5% Bitcoin and taking it out of the bond portfolio to do that doubles your return to 275%. But for the bold, adding 10% of Bitcoin to your portfolio quadruples your return to 495% and a whopping 19.5% annualized
Enter
rate.
James Lavish, former hedge fund manager and managing partner at the Bitcoin Opportunity Fund. At Bitcoin Prague 2025, Lavish shared an empirical breakdown of how portfolios would have performed over the past decade by adding just a touch of Bitcoin. Let's start with the control group, the classic 60-40. Total return over the past decade, 127%. Annualized return, 8.5%. Not bad, but not great either, especially when inflation-adjusted returns dip closer to neutral. Now look at what happens when you replace part of the bond allocation with Bitcoin. 1% Bitcoin. Total return 153%, annualized 9.7%. 5% Bitcoin, total return 275%, annualized 14.1%. 10% Bitcoin, total return 495%, annualized 19.5%. All this with a relatively conservative allocation strategy, not full risk on, just thoughtful rebalancing. This isn't just about performance. It's about correlation and convexity. Bitcoin is non-correlated to traditional assets over long time frames.
What do I mean by ease in collateral terms? Later today, the US Fed is going to vote on something called the SLR, the supplemental leverage ratio. Really fancy term, but what it means is that they're going to remove US Treasuries from the calculation that banks use on their liabilities. What does that mean? That means that the banks can now buy US Treasuries ad infinitum, as many as the US government needs to sell them, and they'll make money off of it, off the spread. It's mental.
It offers asymmetric upside, meaning small allocations can materially move the needle on returns without blowing out volatility targets. Institutions don't need to go all in. A 1 to 5% position is enough to act as an insurance policy against monetary mismanagement and a turbocharger when the macro winds shift in Bitcoin's favor. And remember, we're not replacing equities, we're trimming bonds, the part of the portfolio that's already failing to deliver. We're entering an era where institutions can't afford to ignore Bitcoin. BlackRock, Fidelity, and Van Eck now manage spot Bitcoin ETFs. Sovereign wealth funds are exploring direct allocations. University endowments are quietly stacking. This is no longer about if Bitcoin fits into a portfolio, it's about how much and how soon. The 60-40 model gave us decades of balance, but the balance has shifted. Bitcoin isn't just speculation anymore. It's a macro hedge, a structural complement, a digital reserve asset for a new era of investing. We've entered a new regime, not a cycle, a regime. It's called fiscal dominance, where government spending is no longer reactive, it's the engine. And monetary policy? It's the fuel line. Rates aren't low because they're optimal. They're low because they have to be. Debt levels are so high, the only way to keep the machine running is to repress real yields, to make sure governments can pay off trillions with cheaper dollars. As Lynn Alden puts it, nothing stops this train. Real yields aren't a glitch. They're not a post-COVID fluke. They're policy. The IMF calls it what it is, a subtle form of wealth taxation. Governments run up unpayable debts, print money, and quietly pay bondholders less than inflation. You think you're earning interest, but in real terms, you're being taxed. The goal is simple: inflate the debt away. And it works, as long as you don't notice. But here's the kicker. The system can't function without constant injections of liquidity. Since 2000, global money supply has exploded. In 2008, acceleration. In 2020, vertical. Over 7% compounded annual growth in global liquidity. Why? Because debt requires liquidity, and irresponsibility demands printing. In the U.S., the Fed's balance sheet grows lockstep with federal debt. That's not a coincidence, it's a mechanism. More debt, more printing, more debasement. So here's the deeper issue. The system doesn't just tax your income, it taxes your savings. Quietly, relentlessly, structurally. You can feel it. Bonds don't hedge anymore. Cash doesn't preserve purchasing power. Fiat is melting, silently. This is where the traditional model breaks down. And as institutions begin to realize that, portfolios will never look the same again. Subscribe for more institutional-grade Bitcoin analysis, and let us know in the comments what percentage of your portfolio is in Bitcoin.